Hello, everyone. Well, the days may be getting a little bit dark and cold outside, but a very warm welcome to you all from all of us here at BKL. Thank you for joining me. I'm Anthony Newgrosh for our latest BKL webinar. Today, we're looking at pre-election tax planning. It's a difficult area. It's difficult to be definitive, but I'm lucky at BKL. We only employ people with an IQ over 180. Unfortunately, that I think is on a cumulative basis, judging by today. But without further ado, can I introduce my colleagues in no particular order? We've got Geraint, Head of Private Client Tax. Hi, Geraint.
Hi there.
We've got Terry Jordan, the legend who is. Hi, Terry. Our
Good afternoon, everybody.
Trusts and IHT. And Andrew Levine, who heads up our property tax services here. Hi, Andrew. Andrew, you're on mute. First pound in the box for Andrew there. Never mind.
You're right.
Hi,
Sorry, I am. Hi, everybody.
We've
There's
got
always
you
one.
now. Before we delve in, though, let me just say, if I may, a couple of words about BKL. We're very excited with the changes that are going on here. This week, we've just brought on board CF Pro, who have joined our merry band, and we're now up to over 250 people strong, based in a single office in sunny Finchley. We've got 25 partners. We've been around for over 40 years now, and we're a top 50 firm, I should say, even. We do have over 30 members in our tax team, and we are now, I'm pleased to say, certified a B Corp corporation, which means we're just generally nice, good people. And it's been a very successful year for BKL. I'm delighted to announce. There you go, a little bit on CF Pro before I carry on. Have a look at their website. You'll see the services they provide, advice on transactions, transitions, and corporate governance. So if you need corporate finance assistance, we're delighted that they're now on board with us. But sorry, I was just about to say, it has been a very successful year for our tax team. We won Tolley's Taxation Awards Best Employer of Tax, and at the Accounting Excellence Awards, we won Tax Team of the Year. So well done, team. But moving on, what are we going to be covering today? Well, we'll start by looking at Labour's proposals. We've heard a fair bit from Labour, what they will and won't do, so we'll flesh out that, and then slightly less from the incumbent party, the Conservatives, as might be expected. But let's see what we can find from there. Then we'll focus on the sort of areas of planning we might want to think about from a personal tax and residency issues, some CGT, IHT planning. Andrew's going to enlighten us all a little bit on carried interest where Labour have made certain proposals. It's been well trailed by Labour that they propose to introduce VAT on private school fees. We'll talk about that. And likewise, a few words on SDLT. Do, though, of course, let us have your thoughts, your comments and your questions. You should be able to chat away in the little box there. We'll take a look. We'll try and answer those that we can during the session. If we don't, apologies, but we will be sending out copies of the slides and a link to this webinar. And if there's any questions we haven't answered that we think are of general interest, we can and we will try and address those there. You can also find on our website the full library of our previous webinars. So if there's anything you'd like to revisit, or indeed if you have any topics you'd like us to cover in the future, do of course let us know. Okay then, so moving on. Before we get into the meat, just a few caveats, as it were. We are, of course, totally impartial here at BKL. This isn't a party political broadcast. We are, it would be fair to say, assuming in all likelihood we will either have a Conservative or a Labour government. It is, of course, possible the Liberal Democrats could be in a coalition. You might want to vote Monster Raving Loony Party. So there is a certain degree of speculation to all of this, but we'll do the best we can and try and at least give you some basis on which to make informed decisions whenever the next election may be. But of course, don't let the tax tail wag the commercial dog. If you've got shares in the next Google, as it were, it might be a very good idea to hang on to those rather than sell them just because you think tax rates may change. And similarly, we also need to be mindful that in many cases where there are changes in legislation, there are so-called anti-forestalling rules designed specifically to stop people taking advantage of existing rates, etc., and trying to plan around a known change. We'll just have to wait and see on that. So there we are. Okay, so to start with, let's just have a look at what Labour have said they will cover. And Andrew, I know you've done a paper on this that I think is on our website if you want further detail. We are going to come back to all of this, so just very quickly. They have talked about restricting tax breaks for non-domiciles, and Geraint will enlighten us a bit more. It may be a reduction or elimination of the advantages of the remittance basis, or potentially reducing the deemed domicile period that has already, as we said, been squeezed, but Geraint, as I say, will enlighten us. Labour have made announcements about subjecting carried interest to income tax. Well, we'll talk about exactly what carried interest is and the impact that that will have, but potentially it does go beyond the traditional private equity structures. We've already flagged up potential VAT on school fees, and Labour have said they would reverse the increase in SDLT thresholds. The one that confuses me is they'll say they'll cut out avoidance. Well, I think, you know, most of us would have a bit of sympathy there, but just bear in mind we already have the largest tax code in the world, so I shudder to think what may yet be added to that. What have Labour said they won't tinker with, though? Well, they said they won't impose a wealth tax, albeit we don't exactly know what their definition of a wealth tax is. They may still look to tax land and buildings through some sort of mansion tax. They've said they're not going to raise the higher rate of income tax from 45%. It was the Labour government who had 50% previously. They said we'll leave it at 45, albeit, as we know, maybe they'll tweak NIC instead. So we have to take it all with a pinch of salt. They said they won't equalise income tax and CGT rates. Now, this was, I think, in their previous manifesto. So this is a shift in policy. And there they'd previously said we'll align CGT rates with income tax, albeit we will bring back indexation allowance or relief for inflation. And that would, in many respects, simplify the tax code. It would get rid of a lot of the mischief about changing or disguising income as capital. And we'll come back to that thought, I think, when Andrew talks a little bit about carried interest later. Labour have said they won't reverse the pension limit, reduce the corporation tax rate, or scrap APR for farmland. So those are the clues. Obviously, things are fluid and may change in the future. By contrast, what have the Conservatives said? Well, very little, as I said, as an incumbent government, but I think we can take a few clues from the autumn statement, where I think the two sort of headlines from my perspective were the cut in employees and self-employed NIC rates, abolition of Class 2 as well, hurrah, and full expensing for businesses, a full write-off of capital expenditure on plant and machinery, etc. There was also the suggestion of future tax cuts, and I think that's where the Conservatives are trying to position themselves. In particular, I think the elephant in the room, IHT, has often been mentioned as a source of possible tax cuts or abolition, in fact. And I know we've got Terry's wisdom with us today. No doubt he can enlighten us a bit more later. Those of you who would like Terry to have an easy life could vote for an abolition of IHT in the next government accordingly. But we'll see. We know no more on that. Hopefully, or maybe in the March budget, we'll get further clues as to the Conservatives' direction of travel and what the likelihood of a change of government is. So those are sort of the headlines, as it were. Now let's delve into a bit of detail, as it were. And we're going to start by focusing on personal tax and residency. And at this point, Geraint will dust himself down, and I think he's going to enlighten us to start with on the remittance basis. So Geraint, over to you, mate.
Thank you very much, Tony. Well, those of you who have read as many manifestos as I have will know that Labour nearly always insert a few comments about how they're going to either reform or abolish the non-domicile and remittance basis system of taxation that we have. It looks as though this time they might actually do so, or at least do something. They've been very woolly in the information they've given out. They've so far said that they're going to replace the non-dom regime with what they describe as a more modern system that's going to focus on short-term visitors. Exactly what a short-term visitor is anyone's guess at the moment. Will it be 5 years? Will it be 10 years? It's very hard to tell. So planning for what they may or may not do is going to be very difficult. However, if we start with a kind of assumption that the non-dom status could well go, and anyone who you've got as a client who's been non-dom and claiming the remittance basis for a number of years now might want to consider at least taking action to protect themselves from any changes in their status or their ability to claim the remittance basis. So I've jotted down 2 or 3 things that they might want to consider doing. I've got established excluded property trusts there. Now, I'm not going to go into any detail on that because that really is Terry's patch and he'll talk about it going forward. But it's, in simple terms, it's basically a way to put your non-UK situs assets into an offshore trust so that it remains outside of the grasp of a future chancellor for inheritance tax purposes. Other issues that you might want to consider: accelerating overseas income and gains. Now, this would be in the scenario of a non-dom remittance-based claimer who could decide that they're going to pay the remittance basis charge for one last year and liquidate and distribute everything they possibly can out to overseas accounts, so that from 25, 26 onwards, or whenever it happens to be, they will have no further latent gains or income hanging around abroad. And then no doubt they won't be able to bring the money into the UK, but they could at least spend it whilst they're abroad, or use it to finance Michelin-starred tours of French restaurants or anything like that. Another possibility would be to take everything you can out of your offshore trust. Depending on your status, you could well take distributions offshore and keep the money offshore. That's another option. Broadly speaking, I think we need to be thinking along the lines of what you would do if someone was about to become deemed domiciled in the UK. And then we can take the planning from there. Obviously, I mean, as I mentioned earlier, there's a lot of kind of guesswork taking place here. So I think any prospective tax planning needs to be heavily caveated to point out that, you know, you could conceivably end up in a worse position than you would have been if you'd done nothing. But as long as there are good reasons for doing it, it's certainly worthwhile bringing it to the attention of clients.
Okay, all right, thanks, Geraint. The other thing we can do, of course, is flee the country.
Oh, absolutely, yes. I mean, this is a highly effective form of tax planning, albeit it does kind of restrict your lifestyle somewhat. And, you know, there are some tax havens abroad that in theory sound very nice, but in practice would be an absolute nightmare to go and live in, would be very kind of restrictive in terms of a lifestyle. However, I mean, jurisdictions like, say, Dubai still have no direct taxation on individuals there. So moving over there could be quite tax efficient. I've jotted down the names of a few people who, whilst not resident in Dubai, are resident in tax havens around the world. People like Richard Branson, Jim Ratcliffe, Lewis Hamilton, Joe Lewis, Tina Green. They're all well known to be a non-resident. And as a non-resident, they're only really going to be taxable on certain forms of UK source income, predominantly a property income. Care obviously needs to be taken to ensure you don't end up accidentally becoming UK tax resident through poor planning or poor understanding of the rules. Or alternatively, people leaving the UK very often don't fully understand the rules surrounding split year relief and temporary non-residence. So these things can come back to bite you. But certainly there are plenty of people living very pleasant lives in tax efficient jurisdictions. Certain jurisdictions have good tax breaks revolving around them in the way we have a non-dom regime. Italy has a very attractive regime. Portugal still does, although there is suggestion it'll be abolished with effect from the end of this year. I believe Malta has some good tax breaks available. So there's plenty of opportunity to move abroad and use a time abroad as an opportunity to crystallize gains or take income.
Okay, all right, Grant. Let's just focus on dividends, perhaps, for a second. And I think the gist here is to try and take dividends before any election and budget that could increase the rates of tax on dividends. And there's two taxes in my mind here. One is the income tax rate you pay. It's currently 39.35 or 0.36, depending on who you ask, as a higher rate taxpayer on dividends. But also, if you've gone non-resident, there's the risk of withholding taxes. The UK is quite unusual, and maybe, I don't know if any of my esteemed panelists can help me out here. We have no dividend withholding taxes at all. Although most double tax treaties do provide for reduced rates, we're starting from zero here. And it's always struck me as quite odd and very generous, to be honest. If you are sat in a tax haven, perhaps it is appropriate that you pay some UK withholding tax. So any thoughts, Geraint, that could change? Easy win?
Well, I've always been surprised we don't have it. It seems to be a very easy way to pick up some income into the exchequer from non-resident people and even non-domiciled people who have got no real connection with the UK, could end up paying, 15% is the standard withholding rate on dividends. There's no reason why people shouldn't have to pay that. We all have to pay it when we receive dividends from foreign companies. And those of you who've held shares in firms like Santander will know that it very often gets a tax withholding at higher than the treaty rate, presumably on the grounds it's such a bind to make all the applications to the tax authorities to get the money back that no one ever really bothers. So it's always rather mystified me why chancellors don't ever do this.
Yep, easy win. Okay, you made the point before about, it's not just a case of packing your suitcase and disappearing off to the beach for a while. The residency rules are in themselves very complicated. There's split year rules, temporary absences. Even if you become non-resident, dividends can fall back into the UK tax net if you come back quicker than anticipated, can't they? And who knows what might happen in the next pandemic. One guy who did get it wrong, though, was Lord Sugar. Do you want to just enlighten us a little there, Geraint?
Indeed. I mean, we should caveat and say there's no suggestion that he did actually do this, but this was certainly on the cards. He was, and he got a bit of publicity as well. He was spending a lot of time out in Australia because he was filming the Australian version of The Apprentice. And somebody suggested it would be a good idea if he were to be non-resident, and therefore he could pay a dividend out of, I believe it was Am's Hold, which is one of the holding companies in his empire, whilst he was non-resident and escape UK tax as a result. The figure bandied around in the press was 186 million of tax would be saved. However, unfortunately, life isn't that simple. In 2010, HMRC introduced a new rule basically saying that members of the Houses of Parliament would be deemed to be UK resident and domiciled, irrespective of whether they actually were. So this would not have worked for Lord Sugar if he had gone ahead with it. There was a suggestion that he could have resigned as a member of the House of Lords, which a number of Lords did do that at the time that the law was introduced. I've made a note of a few of the more prominent names there. Lords Foster, Bagri, McAlpine, Laidlaw and Lady Dunn as well, all chose to waive their or surrender their lord and ladyships because they didn't want to pay the tax. This has kind of slightly struck me as being a bit of a storm in a teacup as a piece of news, because if Lord Sugar had paid out a significant dividend out of one of his holding companies that presumably was holding investments, and then gone non-resident for a year and then come back again, the anti-avoidance rules on temporary non-residents would probably have brought that tax back into charge in the UK anyway. So I don't think it would have had any a real net effect. So I think it was more a newspaper story than anything else.
All right, but if you are thinking of going abroad, this is not a simple matter from a tax perspective, is it? You need to consider the UK consequences, the overseas consequences, and it's not a sort of once and for all fire and forget piece of advice. You do need to review things and make sure you don't fall foul of any rules that can recapture income and gains, for example, should you come back to the UK. So we can certainly advise, both with our team of internal experts and through our international network, if any of you are considering retiring to the beach anytime soon. Okay, let's just say a few words on pensions. And Geraint, help me out here. Did I get it right in the introduction? I said Labour said they won't reverse the pension limit. Is that correct?
Well, I think they made a comment along those lines, but didn't actually clarify what they considered the limit to involve. So whether it was an annual, your lifetime allowance or your annual allowance. I mean, in the past, they've talked about everyone getting tax relief at pension contributions at the same rate, which, I mean, at the moment, as you'll all be aware, you get tax relief at the marginal rate of tax, unless you're earning, is it more than 240,000 a year, in which case you start getting involved in a tapering as to the amount of money you can put into the pension fund each year, but still retain the ability to claim the relief at your marginal rate. Now, despite the freezing of thresholds over the last few years, I think we're still looking at the majority of people probably still only pay tax at 20%, and therefore when they're getting their tax relief on pension contributions only get it at 20%. So it is possible Labour might make everyone only get tax relief at 20%, or may come up at some point in between the two, say 30%. Or 32.5%, what happens, they happen to think is an equidistant point. So, I mean, I suppose a piece of kind of basic planning would be to load up your pension fund as much as you can prior to a change in government. Because I suspect it's a reasonably safe bet that Labour aren't going to allow people to put in more money into their pension funds or get more tax relief than they're currently getting. So for a higher rate or an additional rate taxpayer, that might be a bit of decent planning. I mean, I put a note down the bottom there that pension funds are still a marvellous inheritance tax planning tool. And I don't know whether Terry's going to touch on this a bit later. But the basic rule is that if you die before you're 75, your fund goes down to your beneficiaries inheritance tax free, and they can draw on that tax free as well. If you die after 75, then the pension fund goes down inheritance tax free, but any withdrawals from it are taken out at marginal tax rates. But it's still a marvellous piece of inheritance tax planning, and is very often the last source of monies that somebody should tap into as they go into their dotage. And I can see Mr. Jordan wishes to make a comment.
It was only to endorse the point you just made, Geraint, about spending other money before touching the pension, if that's a possibility. And just a brief warning, if somebody is in serious ill health, oblique, sadly on their deathbed, then they can't simply stuff the pension because HMRC up with that will not put. But as a generality, certainly at the moment, they are very inheritance tax efficient. There has been a suggestion that inheritance tax should be imposed on pension funds, which of course is a possibility if there is a change in government. They were the only immediate points I wish to make just now. Thank you.
All right, thanks, Terry. Look, I think the message is, as you said, Geraint, pensions remain a very tax efficient vehicle, and we should all make sure we make maximum use of them. It's been bandied around for many years, hasn't it, that the higher rate tax relief on pensions could be capped. So we wait and see. But yeah, if you need pensions advice, and again, BKL and our financial services team will be very happy to help. Okay. So those are some of the personal tax issues that we need to consider. We're going to move on now and just look at CGT. Again, we've heard rumours of increases in rates of CGT. I think Rachel Reeves has come out and said actually they don't intend to increase the headline rate of CGT. That said, they may tinker with some of the reliefs. Entrepreneurs relief or business asset disposal relief has been a great benefit to many taxpayers over the years. Used to allow up to £10 million of lifetime gains to only subject to a 10% rate of tax. We're down to £1 million, so it's £100,000 of potential benefit. I wonder if that could go. Not very entrepreneurial, but there you go. There's its sort of sister or first cousin twice removed, investors relief. I don't think gets the publicity it should, but broadly, again, a 10% rate of tax on broadly external investors with a £10 million lifetime limit. Might that go, or might that be tweaked? Again, we don't know, but look, I think the pressure on CGT rates is only going to be northwards, as it were. So if you are looking to try and crystallise gains before the next election, just a few thoughts. One possibility is to use incomplete contracts. So you would exchange, you would enter into a binding contract pre the next election. Now, the date of disposal for CGT purposes is the date of exchange for completed contracts. And apologies, I don't think you should say complete pre-election. Cross that bit out from your minds. There's only a disposal, though, when you actually complete. So although the date is fixed beforehand, it's only once you complete that you have an actual disposal. So you enter into a contract but don't complete. Bear in mind that if you do complete, the disposal is backdated to the date of exchange. So you might have interest, etc., to pay. And Finance Act 23 dealt with a little anomaly where if there was such a gap between exchange and completion, HMRC may not have the machinery to assess that by reference to the date of conveyance. So that has now been resolved in HMRC's mind, and I think that's fair enough. So the principle here is you could enter into a contract, an unconditional contract, you exchange, but you don't complete. And then once we know what happens at the next election and the rates, do you complete and therefore hopefully tap into the rates that apply at the date of exchange, or simply just leave the contract outstanding forever, maybe void it, etc., and therefore the deal just falls away. As we said, I think this comes with a word of caution. It is entirely possible that anti-forestalling rules could be introduced, as they did when they played around with entrepreneurs relief or business asset disposal relief, but it is something worth thinking about. The other alternative is to dispose of your asset that's pregnant with a large capital gain to what we call a friendly party. So that could be, say, a family member. A spouse is probably not going to work because that would normally be on a no gain, no loss basis. Bear in mind, if you are disposing to what we're broadly terming a friendly party, you're probably going to be subject to the market value rule. So the disposal would be deemed to occur at market value, irrespective of the actual consideration that's paid. So if you transfer them just for £1, you may well get a very large dry tax charge that you cannot fund out of your £1 worth of proceeds. And we're also mindful of the so-called transaction and securities rules. Now, we said before about the possibility of aligning income and CGT rates. These rules are designed to stop mischief where you hide something that is really income in nature and say it's subject to CGT. Transaction and securities rules stop you from doing that in respect of shares, debt, well, formalised debt such as debentures, etc. So, for example, if you were to seek to sell shares into a company that you owned 100% of, yes, you've made a disposal. Yes, in theory, it's a capital disposal. Yes, in theory, you might be entitled to only a 10% CGT rate. The transaction and securities rules will tax you on the proceeds you take for that as an income dividend. Probably fair enough. The other option, Mr. Jordan, help me out here, is to look to transfer assets into trust. Terry, do you want to give us just a quick heads up here?
Well, certainly a transfer to trust would be a possibility. You would then want to decide whether you were going to pay the capital gains tax at the current rate or whether you were going to claim holdover relief. If a settlor transfers assets to a trust, then holdover relief would be available to business assets, and also if an inheritance tax charge arises. And since the changes that Labour made in March 2006, almost all lifetime transfers to any sort of flexible trust are immediately chargeable. If you are looking to hold over the gain, you need to watch that you don't have in the class of beneficiaries the settlor or his or her spouse or civil partner, but also minor unmarried children. And it's also important that the trust is so drafted that if another child were to, as it were, pop up, he or she should not be capable of benefiting until age 18 or exceptionally earlier marriage. Otherwise, there would be a clawback of the held over gain. But of course, if what you're seeking to do is lock into the current capital gains tax rate, then holdover relief wouldn't be, you wouldn't be seeking to claim holdover relief in those circumstances.
Okay, thanks Terry for clarifying. One other area that's gaining increasing traction is employee ownership trusts. These were introduced, I think it was 2013 or 2014, to incentivize owners to pass on their businesses to its employees. And it did that by allowing a 0% rate of CGT on the disposal of a controlling interest in a trading company or group. Pretty good rate. We're not going to do any better than that. So grab it while you can, maybe your view. So you sell the company to the trust, and the trust controls the company on behalf of the employees. And the consideration for the vending shareholders is effectively paid out of future profits of the company that it pays up to the trust, and then the trust uses to settle the debt. It can borrow externally as well, so there's a certain degree of flexibility. But from the vending shareholders, this is brilliant, 0% rate of CGT. And there's other incentives for the employees. In particular, they can be paid a tax-free bonus of up to £3,600 per annum. There's still NIC on that, rather bizarrely, but there you go. But still quite nice income tax saving. Just bear in mind, though, that this is an all-employee scheme. All employees must benefit, albeit you can vary the amounts by reference to, I think it's salary or length of service. Bear in mind also, you might initially get your 0% rate, but that CGT rate can be withdrawn if a disqualifying event occurs before the end of the next tax year from sale. So if, for example, the trust no longer has control of the company, if, for example, it breaks the requirement that all employees must benefit from the trust, if the company is no longer trading, then there's a clawback of that tax relief, and that falls back on to the vending shareholders. If that disqualifying event occurs after the end of that following tax year, then it's the trust that has to pick up the tax. We have done a previous webinar on employee ownership trusts, so of course this is just a flavour. So if you want more details, you can have a look at that. There's also further details on our website. And just to flag up, there is a consultation going on at the moment. It's mainly just to smooth some of the edges, and we're not expecting wholesale changes. For example, the fact you don't get an NIC break on those bonuses, points like that just seem a bit petty. So we'll keep an eye on that. And of course, through our brass tacks, through our website, we'll let you know if there are any substantive changes there. So that's what we're going to say about CGT. Grab current rates if you think that's appropriate now, albeit you might be crystallising a dry tax charge. So, and as we said, be aware, obviously, of the commercial implications of what you're doing. Let's move on now to IHT. Mr. Jordan, the floor is yours.
Thank you, Tony. In my experience, there's still some misunderstanding about quite how the scope of IHT is determined, and it's determined by a person's domicile. So if a person is domiciled within the United Kingdom, technically you're domiciled in England and Wales or Scotland or Northern Ireland, but we tax people tend to use the shorthand of UK domicile. So if you're domiciled within the United Kingdom, then the scope of inheritance tax extends to your worldwide assets, and some confusion arises in territories where there used to be some sort of tax on death, and that's now been abolished. For instance, had I a holiday home in the Portuguese territory of Madeira, then although Portugal doesn't have any equivalent of inheritance tax on death, because I'm domiciled within England and Wales, there would still potentially be inheritance tax on the property there. And just to say a word about what domicile actually is, to listen to Rachel Reeves, I think you'd be forgiven for thinking that all of Labour's spending plans are going to be met by tinkering with the domicile rules for tax purposes. But of course, domicile is much more important, arguably, than only the effect it has on tax. And it's actually one of the things the Romans did for us.
What have the Romans ever done for us, Terry?
Well, plumbing, central heating, all that sort of thing. So it originated in the Roman Empire when, following the downfall of the Republic, Italy was divided into a number of individual townships known as municipia, and the empire was fragmented into numerous provinces. Each province and municipium possessed its own jurisdiction and its own divergent internal law, which was administered and enforced by magistrates. And most inhabitants of the empire were connected by citizenship with one or more of these provincial or municipal communities, and or with Rome itself. And they said that the link of citizenship could arise in various ways by origio. That may be ringing a bell with people who are interested in domicile. And that was the place within the empire to which a person's father, or if he was illegitimate, his mother belonged, by adoption, by election, or by manumission. And the last of those is not the nightclub of my youth in Ibiza, but the freeing of slaves. So domicile has a very, very long history. And as I say, it's critically important when thinking about inheritance tax. So as well as domicile at general law, there's also deemed domicile. And until April 2017, to be deemed domiciled here, if you had a general law domicile outside the United Kingdom, required you to be tax resident for 17 out of 20 tax years. And that's usually referred to as applying only to inheritance tax, a sort of pub quiz question, or an unlikely pub quiz question, arguably, is that it also could impact on the income tax charge on pre-owned assets, or POAT. And then the rules changed with effect from the 6th of April 2017, when deemed domicile applied to all taxes, including inheritance tax, and the period became 15 out of 20 tax years. So it looks, as we were saying earlier, as if what Labour have in mind is to telescope the deemed domicile period and shorten it. And I don't think there's yet been any suggestion of the period that it might turn into, but it might be something like 3 years perhaps, or 5 years, because they clearly recognise that they're going to have to do something about short-term residents who are domiciled outside the UK. Otherwise, very few people would come here. So planning for non-doms, people who at the moment are not general law domiciled within the UK and are not yet caught by the deeming provisions. And the most obvious possibility would be to create an excluded property trust. And put a note on the slide, the essential features of an excluded property trust are relatively straightforward. All that matters is that you have a settlor who at the time the trust is created, and also at the time of any additions subsequent to the creation of the settlement, is not domiciled nor deemed domiciled within the United Kingdom, and that the trust going forward holds non-UK situs property, or for the last dozen years or so, authorised unit trusts and open-ended investment companies, OICs, are also excluded property in a trust settled by a non-domicile. And under the current rules, that beneficial inheritance tax treatment would subsist for the lifetime of the trust. So even if the settlor were to acquire a domicile here at general law, or if he or she were so long resident here that they became caught by the deeming provisions, that beneficial inheritance tax treatment would subsist. The trust doesn't have to be non-UK resident. That's often a misunderstanding, although it usually is, but that's from the point of view of capital gains tax potential benefits rather than inheritance tax. So from the inheritance tax point of view, you could have UK resident trustees. And the last note on this slide is to watch out for returners. And they are people who are UK born with a UK domicile of origin. And this provision was brought in, it was anecdotally popularly thought to be targeted at a particular banker who had so upset one of the Treasury committees that they brought the provision in just to spite him. So if, as we have had in the case of some of our clients, people who have left the UK, in one case were resident in the Middle East for 30 or 40 years, had clearly acquired domiciles of choice outside the UK, having done that, settled a trust, and then unfortunately came back to live in the UK and become resident once again, those settlements could no longer hold excluded property. So it's fine if you were somebody who was born outside the UK, even if you were born with a UK domicile of origin, which you would normally have taken from your father at the time of your birth. But if you're UK born with a UK domicile of origin, then I'm afraid this planning simply won't work. Another thought, which doesn't appear on the slide, is that we have only a small number of double tax treaties with other jurisdictions that cover what now is inheritance tax here. And some of those treaties are still in force, despite the fact that the territory with which we have the treaty has abolished its estate duty or its equivalent of inheritance tax. And this is with particular reference to India and Pakistan, where it's always worth asking the question of a client as to their general law domicile, because at best, the effect of the treaty can disapply the deemed domicile provisions. So you could have somebody who's Indian domiciled at under the law of India and not domiciled within the UK under our domestic law, and then only in connection with assets passing on death, if they're non-UK situs and dealt with under a non-UK disposition, so in other words, a non-UK will, they can potentially avoid inheritance tax altogether, regardless of how long the person has been here. And that was the issue in the recently reported case of Mr. Shah, where it was claimed that he had not acquired a domicile of choice here, but he had been here for many, many years and had reached a grand old age of approaching 100 when he sadly passed away. And it was held that he had acquired a domicile here, and so the treaty was of no help to him. But always worth asking the question. And if you have clients who have left the UK with a view to not only ceasing UK residence, but also to try and shed a UK domicile of origin, then do watch what they get up to after they've left the UK, because a couple of fairly well-known cases, Richard Burton, who had lived for some years in Switzerland, his request for burial of his body in a red suit together with a copy of Dylan Thomas's poems was fatal to his plans to avoid UK inheritance tax. I don't think that case ever actually was litigated. I think the executors just gave up. And it was 2 and a bit million of inheritance tax. And another one that was litigated was Sir Charles Claw, who it was claimed was domiciled in Monaco after his death. And it was reported that he was desperately homesick, and although he was looking at properties in other jurisdictions as well as Monaco outside the UK, it was held by the court that he was still domiciled in England and Wales. So if you have clients in those situations of having left the UK with a view to claiming non-UK domicile, then do watch what they've got up to. Things like membership of clubs. I had one client who'd lived in New Zealand for some time, and his RAC card literally fell out of his wallet, and it wasn't a breakdown service, it was the RAC club, and that was potentially unhelpful. Now, I think in the words of Sir Chris Whitty and Sir Patrick, next slide, please. Thank you very much. Lifetime gift. So where we are at the moment is that most outright lifetime gifts to other individuals are things called potentially exempt transfers, and everybody listening will know that if you make a lifetime gift, an outright gift that's over one of the now relatively small immediate exemptions, it will be a potentially exempt transfer, and there will be no inheritance tax provided you haven't reserved a benefit and provided you live 7 years. And if the quantum of the gift is over the nil rate band, then if you live at least 3 years, you'll have a measure of taper relief. But again, a common misunderstanding is that taper relief reduces the capital value given. It doesn't, it reduces the tax. So only if the gift is over the nil rate band will taper be in point. Will pets be put down? Well, I remember in 1997, a barrister who's now a KC said that Lincoln's Inn was absolutely convinced that Labour were going to abolish pets, and they did no such thing. Those of us with long memories, or like me, just very, very old, you'll have seen the picture at the beginning. You should see the one in the loft. Estate duty worked on a similar sort of basis to inheritance tax, in that if you made a lifetime gift in good enough time, there was no tax. Then capital transfer tax was introduced in the early 1970s on a rolling basis, with lifetime gifts coming in first and then tax on death. And originally there was lifetime accumulation of gifts, so it's not impossible that we might go back to that sort of system. I think by the end of capital transfer tax, it was a 10-year accumulation period. Another thought is that we've had a single rate of inheritance tax since 1988, when the late Nigel Lawson aligned all of the main tax rates. Prior to that, it was sometimes worth paying some tax on the death of the first spouse, for instance, if that meant that the rate on the death of the second spouse was lower. So that's a possibility. Nothing really to be done about planning in advance for a change in rates. My personal view, for what it's worth, is that pets won't be put down. So phew, that's a relief. This is just another one of my terrible jokes. Agricultural property relief. Labour have said recently in the Financial Times that they're not going to abolish agricultural property relief. I think for genuine farmers, it would be a travesty if they did, because it would lead to the breakup of proper farming businesses. Do bear in mind, though, that APR is all well and good, but it only ever applies to the agricultural value of the asset on which you're claiming the relief. So increasingly, we're seeing that the fringes of farms, if not greater areas, have development or hope value. And then you would want to be able to claim business property relief as well as agricultural property relief to cover the hope value. I think it's a question of generally waiting and seeing. Taking aim. Most of our listeners will know that one way to mitigate inheritance tax, a very easy way to have the benefit of business property relief, particularly for elderly clients, is to invest in a portfolio of companies on the alternative investment market, most but not all of which benefit from business property relief subject to the minimum holding period of 2 years. And if you're advising husband and wife, in brutal tax terms, only one of them needs to live for 2 years, because the surviving spouse picks up the deceased's period of ownership on death. That would be an easy target. Again, in 1996, 1997, I was saying to clients that it was only in April 96, I think, that the requirement to have more than 25% of the voting rights in a company was there to get the higher level of business property relief, and that was changed in 1996, and Labour were coming into power in 1997. And so I was telling people, if you're giving away some of your shares, make sure you keep more than 25% in order that what you keep has the benefit of the higher rate of business property relief. That would be an easy win if they wanted to attack the AIM and similar strategies. I think there's none of us certainly are allowed to give investment advice, but I think there might be another issue, which is that if the BPR rules were changed and adversely affected AIM, it might be that there would be a big sell-off where people are holding the AIM stocks only for the benefit of the relief. So it might be a sort of double whammy.
All right, Terry, time marches on. So do you want to just cover off the planning to lock in relief? And
yeah,
then
of
we
course.
can cover off our final points.
So we were talking earlier about perhaps using a trust to trigger a capital gains tax disposal. Just a point to emphasise is that if what you're disposing of with CGT planning in mind into a trust does not benefit from business property relief, then you need to watch the IHT treatment, because you would otherwise have a 20% inheritance tax charge on the value over the nil rate band. If you are transferring assets into trust that do at the moment benefit from 100% business property relief, then that could actually be more beneficial than an outright gift. And this is because of the odd way the retention rules work. Business property relief is a relief, not an exemption. And on death, the distinction doesn't really matter, but it does matter on a lifetime gift. So on a lifetime gift, if you were unfortunate enough to die within 7 years, the BPR is revisited and it's denied unless the asset that's been gifted is retained by the transferee. So in the case of a trust, that's the trustees. And also in most cases, needs to benefit from BPR on a notional disposal by the recipient on the date of death of the original transferor. Now, there's a wrinkle on a transfer to trust, which is that if you transfer assets that benefit from 100% BPR, then if you die within 7 years and the trustees no longer hold them, if the transfer's within your nil rate band, there's no inheritance tax and there's no effect on your cumulative total. So if I put in 325,000 worth of 100% qualifying BPR assets into a trust today, and then do not make the 7 years, because it was an immediately chargeable transfer, no IHT and no impact on my cumulative total. So I think before Tony completely falls out with me, I shall dry up.
Thank you, Terry. Right, I'm going to hand over to Andrew. Andrew, the next point we just wanted to cover was carried interest. Maybe just before we get into the detail of changes, could maybe just summarise, I think people have different misunderstandings here. What exactly do we mean by carried interest, Andrew?
Okay, but a carried interest is essentially where a manager has a share in a business which gives him or her the right to a share of profits above a hurdle. So a fairly typical arrangement would be once other investors have achieved a 10% IRR, the manager gets a 20% of all profits above the IRR. I mean, typically the manager doesn't pay a significant amount for his interest. So in some ways, the carried interest return is probably, it's a bit more like a bonus than a true investment. But for tax purposes, the carried interest is treated as a share in the profits of the fund. So if the fund makes a capital gain, the manager is taxed at capital gains tax rates on his share. And carried interest has been very, very widely used in the fund management industry. It's not restricted to the fund management industry. Other people can have carried interest as well. As far as the fund management industry is concerned, I mean, this particular treatment was all agreed in a deal between the British Venture Capital Association and HMRC in 1987. And it's this particular practice that led to the remark that fund managers paid less tax than their cleaners. So what Labour have said is they're going to end what they call the Mayfair tax loophole. They call it that because many fund managers are based in Mayfair. Very little detail, as always, on what they're actually going to do, but presumably the upshot is that carried interest will be taxed at income tax rate rather than capital gains tax rate. I think the presumption is it will probably apply only to fund managers. That's what they're aiming at. But question mark, could it apply more widely to other sorts of carried interest? They also haven't said whether the carried interest will be taxed as employment income or as trading income. And it's worth noting that even under current law, in certain scenarios, a carried interest can be taxed as income. And those are in situations where there's no links to profits or no risk of the carried interest not being received, and also where investments are only held for a short time. But under current law, it's taxed as trading income, not as employment income. But we'll have to see what the Labour proposals are. Anthony, I'm conscious time is running short.
All right, we'll crack on, if we may. Just going to very briefly mention then VAT on private schools. I think this has been well trailed. It's been in the Labour Party manifesto. Seems a little bit petty, quite frankly. I don't think it's going to raise a fortune, but there you go. It's been suggested, what if you prepaid your school fees? Let's say you say, I'll pay the next 5 years worth of fees. Current rate of VAT, no VAT at the moment, thank you very much, but we've certainly seen anti-forestalling measures in place that could stop you doing that. So yeah, you might take a view it's worth a punt if you're prepared to lay out the cash up front, but just be aware such arrangements have been blocked in the past. And the other point is, how far will these changes go? I mean, is it just school fees? What about universities, nurseries, academies? And our colleagues of Landau Baker, who do specialise in schools and academies, will be happy to advise you more generally there. But also, what about provision of transport? Might that be brought into the VAT net, etc., etc.? So although we know the broad principle of what Labour are driving at here, there is a fair amount of detail. And although, as we said, there may be some planning you can do, it's not entirely without risk. So I think that's all we're going to say on school fees. Andrew, bring us home. We were just going to say a few words on stamp duty land tax and possible land value tax. Over to you.
Yeah, so Labour opposed the stamp duty land tax cuts for purchases less than 500,000. So I think there must be a risk that they will reverse that. The obvious planning, I suppose, is to go out and buy your property before the next election. We have, of course, seen all this before, where people have rushed out to buy property before some adverse tax change, and they end up paying very silly prices just to avoid what can sometimes be quite modest rates of tax. And just finally, while we're on property, a note on business rates. I mean, Labour have said that they want to reform business rates. It's not yet clear what they want to replace it with, but there has been mention of a land value tax, and certainly land value tax is popular with some sections of the party. And Anthony, you alluded to this before. You called it a mansion tax, and I think essentially that's what this is. So although Keir Starmer has ruled out a wealth tax, it's not entirely clear that this also excludes the possibility of a land value tax. So that is also a space to watch.
All right, just one final thought, Andrew. We were talking before with inflation being at coming down now, but has peaked at around 10%. It may be property investors will quite welcome paying higher headline rates of tax if they got relief for inflation going forward. So difficult to say at the moment, isn't it?
Yeah, I mean, that is not part of the current Labour policy. I mean, what they've said is they're not going to change the CGT rate. But it was a proposal in the previous manifesto where they were talking about aligning the CGT rates and and income tax rates, but with the proviso that they would bring back indexation allowance. Now, for most asset owners, that's probably not terribly attractive, but for property investors, it's probably not bad news, because the indexation allowance would probably wipe out a good slice of their gain. So even though they were being taxed on higher rates, their actual tax bill could be less. But as I say, that is not a current proposal. That is not in the current proposals for CGT. Well, I think the official stance is no change.
Indeed, but yeah, just interesting to compare. Although most people would be, shy away from the thought of aligning those rates, it could even be beneficial in certain cases. But there you go. Okay, that is about it. I've been asked just to clarify, I think, one point, Geraint. I think when we were talking about Lord Sugar, I think he did actually pay the dividend and did actually end up suffering the tax. So a couple of people asked to clarify if that was proposed planning or he did actually get his backside spanked on that one. I think he did get caught, according to what I've seen.
I believe that it did go ahead, and he didn't make the claim because it became apparent that it wasn't going to work prior to him filing his tax return. Although that is all allegedly. I've got no inside knowledge at all on the subject.
All right.
I wonder what he said to his advisors with regret.
Yes.
Yes. I hope they've got good PI cover. So that's it from us. Thank you, Geraint. Thank you, Andrew. Thank you, Terry, for your pearls of wisdom. As I said, we will be sending out copies of the slides to you all. We will be uploading this on our website, and we will obviously keep an eye on things as time progresses, as further announcements are made, as we move closer to a general election. So hopefully those are some of your options. Obviously, as we said before, unfortunately, a lot of this is just speculation, and we'll have to see which way the election goes in due course. But for now, thank you for joining us. We wish you all a very Merry Christmas and our very best wishes for the new year. Keep well. As I say, do let us know if you've any topics you'd like us to cover in the future. We're all now probably going to bury our heads in the sand of personal tax returns for the next couple of months, but I'm sure we'll see you early in the new year. So thanks very much, everyone, and goodbye.